We got Dan Niles with us this morning from AlphaOne. And Dan, you said you're still worried about the macro story, but there are some themes that I want you to talk about that has you looking at certain technology stocks that you like. What are the big themes that you want to invest around this year?
Sure. Yeah, I am very excited about certain areas. I think one is that every 4 years you get this great confluence of events, which is you get the Olympics and you get the presidential elections. That by itself puts another $10 billion or so into advertising demand. And when you look at what's going on right now, a lot of that's being really waged in the media, in video. And so if you look at this last year, advertising up maybe 3 or 4%. Underneath that, though, online advertising was up about 17%, and video online advertising was up about 40%.
Wow.
So as you head towards the third quarter when the Olympics start, and particularly in the fourth quarter when candidates are really going after the presidential elections, they're going to be using Facebook, for example. They're going to be advertising online with Google to try to target the voters that they want to get out there and vote for them.
So you want to be buying Facebook, you want to be buying Google.
Especially as you head into Q3 and Q4.
But what about the valuation story there? I mean, I don't think there is anybody on the planet who traded Facebook better than you did. I remember when the stock first went public, where you were then, you shorted it, then you bought it, and you just have handled this stock so well. So give me your sense of Facebook and its valuation here.
Sure. Now, this is what's interesting, because when you look at Facebook, last year the stock was up mid-30% range. It was actually cheaper at the end of last year than it was at the start because the revenues actually grew 40%. That's not the same with Amazon or Netflix, where those stocks were up over 100% each, but the revenues were up 20%. So Facebook is one of those interesting stories where the revenues are growing so fast. Revenue growth actually accelerated year over year for the last 2 quarters, and I think that's actually potentially has a chance to do that again in March. So, you know, the valuation certainly at 40-something times on its surface makes you nervous, but you're buying it for a company that's actually growing even faster than that.
What about Google? Same thing in terms of valuation?
Google, the valuation's a little bit trickier, because if you look at Google, revenues grew about 16% last year. Now, they also did accelerate year over year for the last 2 quarters, but it's trading at 20-something times. There you don't have sort of that same discrepancy where you can get as comfortable with, but certainly at 20-something times, it makes you a lot more comfortable owning it.
I see. All right, now I want to ask you about Apple. We've been having this discussion the last couple of weeks about this FBI versus Apple situation. They're all going to be at a hearing tomorrow. Regardless of what comes out of that, you don't like Apple as a stock.
I don't like Apple.
You've been shorting it. You are recommending avoid it.
Yeah, and this is, you can go online and see we've been talking about that since September of last year. So this is not something new. I mean, the real problem with Apple is, we both are sitting here with smartphones, but what new feature are they adding to your phone that's going to make you run out and buy a new one? There really isn't a whole lot more to add. And on top of that, they count on China as their second biggest market. It's the #1 driver of growth for them. A lot of these economies and emerging markets are slowing down. So the stock's certainly cheap. I love my Apple products, but right now, the fundamentals, I think numbers have to continue to come down.
So is there a catalyst out there that would make you change your mind? It's just going to be new products, something that you're going to believe in.
Something you have to be excited about, but think about the new features they're telling you is coming out with the iPhone. Well, the camera is going to be a little bit more flush with it. You might have like little rounded edges. Camera's a little bit better. Well, if that were the case, the PC market would be growing because every year it's faster and more performance, but it's been shrinking for 4 years. So I think the smartphone's gotten to a point where it's mature enough where it being faster and the camera being a little bit in isn't going to help you drive a lot more sales.
The China story has been driving markets so much for the last year or so. I know that's one of the issues for your feeling that the macro story is going to get worse, and we're going to see another 15–20% decline in U.S. stocks this year, is what you said earlier.
Yeah, it concerns me that could happen.
What are the leading groups that are going to be poised to really take that hit, do you think?
Well, I think the technology space, honestly, is the one that scares me the most. So Facebook may be my favorite stock, but in that environment, it's going to go down as well.
I'm glad you said that, yeah.
Now, the problem here is the following. The IT spending environment is about $2.7 trillion per year. Within that, banking is about 18%, excluding insurance, which is another 8%. We heard Jamie Dimon at JP Morgan talk last week about how his business is under pressure due to dropping commodity prices, specifically oil, and lower interest rates.
Right.
On top of that, natural resources and manufacturing is another 18% of IT spending. So all that pressure on about a third of IT spending you're going to start to see really come forward as we go through this year. You saw Cisco, they talked about a slowdown in January. You saw HP, which isn't necessarily the greatest company, but they said we got inventory issues and PC market won't get better till the second half of the year. So you've got to really worry about the tech space, and to your point on valuation, that's why you really need to pay attention.
So it sounds like the financials you're not going to touch either, but more so than the financials are the customers of the financials, like the IT players.
Yeah, and that's really it, right? JP Morgan's trading at below 10 times earnings. I mean, quite honestly, I'm tempted to look at the stock, but what scares me is the credit environment. They're the best-run company out there. I'd honestly much rather own them than a lot of the IT players and say, oh, well, they're not going to see any of this. I think that's just silly to make that assumption.
Because when push comes to shove, they're going to say, okay, we're going to spend less on IT.
Exactly, because they need to support their dividend. They need to go ahead and generate cash flow, buy back shares. They care more about their business than supporting, you know, a player out there in the IT business. They're going to do what's prudent, and the banks are very prudent.
Really, really interesting analysis from Dan Niles this morning.